So the Urban Institute is a private, nonprofit, nonpartisan research organization based in Washington, D.C. that studies public policy issues, broadly defined. I focus on retirement income security at the Urban Institute. I've been studying this for about 10 years. And what I'm really focusing on a lot is looking at the types of risks that people face in old age. And there's an enormous number of things that can go wrong as people approach retirement and while they're in retirement. And these negative events can have serious financial consequences. The biggest risk that people face after age 65 is the risk of developing long-term care needs. Over a 10-year period, about 25% of people 70 and older will develop a long-term care need. In other words, they're going to need help with basic personal care, things like bathing, things like eating, getting in and out of bed, using the toilet, dressing.
And those are not covered by Medicare?
Long-term care costs are by and large not covered by Medicare. And so many of the costs are paid out of pocket. Basically, the options are that once you need long-term care, if you don't have private long-term care insurance, what you do is you pay for it out of pocket until you spend all your money, and then you go on to Medicaid. People can purchase long-term care insurance. It's not a very common product right now. Only about 9% of people 55 and older have private long-term care insurance. 65 and older, it's about 10%. I think there's two reasons why long-term care insurance is not a very popular product right now. One is that it's expensive. Long-term care insurance is not expensive if you start and buy it at an early age. But, so for example, if you want to buy long-term care insurance at age 40, it's probably going to cost less than $1,000 a year. The problem if you start at a young age and buy long-term care insurance is that you have to keep making those payments year in and year out until, let's say, you're in your 80s. That's when people cash in the insurance. That's when they're going to become frail and need long-term care. If they stop making those payments and they don't have a forfeiture provision in their policy, they basically lost all of this that they've put into it. If you wait until you're in your 60s to buy long-term care insurance, because the risk of needing it is so much higher, then the premiums are really basically unaffordable. I think another reason why people don't want to purchase long-term care insurance is that it's something that we just don't like to think about. People probably think they're going to be healthier than they really are. People think that Medicare is going to pay for it, or Medicaid, or someone's going to pick up the bill and they don't have to worry about it. And that's really not the case.
I've also heard the criticism that long-term care is kind of a difficult financial product to understand.
Long-term care is a very complicated product, probably more complicated than a mortgage, probably the most complicated financial instrument that people are ever going to enter into. What makes it complicated is that you are buying something that you're not going to use probably for 30 years, so that the provision of long-term care could change dramatically over that period. And we saw some of those problems. We see some of those problems coming up right now, so that people bought policies before assisted living existed. And so now they want to use their policies for assisted living and they can't. There are a lot of policies that were nursing home care only policies. Now what's much more common is to get paid home care, but your policy doesn't cover it. It's really important that when people buy private long-term care insurance that they get inflation protection. Basically what you're doing when you buy a policy is you're getting a benefit that will cover, let's say, $150 of care a day for a certain period. You want to make sure that $150 is adjusted each year for inflation, because $150 a day would be enough to cover people, but 30 years from now, that $150 might not be enough, unless it increases each year with inflation. But it's still a really complicated decision to make. In addition to the inflation protection, you have to decide how much do I need, how long should I purchase coverage for? Should it cover 2 years, 3 years, 5 years? What about the exclusion period? There's this, it doesn't kick in until you've been frail for a while. So how long do you want that period to be? It's incredibly complicated. And once you buy the policy, it's hard. You really can't change the terms. So you really have to think long and hard about it. Right now, most experts are recommending that people buy $150 worth of coverage. So that's a policy with a daily benefit of $150. It's important that you get coverage that covers both nursing homes and home care, because home care is becoming increasingly common. So you don't want to have to go into a nursing home if you can at all avoid it. In terms of how long do people need care, I think most people would say 2 years is enough. If you look right now at the data, most people who are using long-term care services use it only for about 2 years. There are some exceptions. An interesting thing that states are starting to do is develop these long-term care partnerships, so that for people who buy private long-term care insurance, after the policy ends, so after your benefit period has been exhausted, then you can go right on to Medicaid without having to spend down. That's not available in all states. It's available in states like New York and California and a number of others. But it's something that's sort of on the forefront of policy changes that we're all starting to think about. How do we improve financial security for people with long-term care needs?